When it comes to investing in large cap funds, often they have the trust of all. But which are the large cap funds should you be investing in? Which are the best and the worst performers amongst the large cap funds? To discuss this and much more, we have on board Mr. Pankaj Manthal, who is the MD at Optima Money Managers. And Pankaj will also answer your queries. So do not forget to write to us your portfolio related queries on a WhatsApp number that is 865-797-4571, or you can also email your queries to us on the email ID that we are just highlighting for you. But Pankaj, let me come to you. A very good evening and thank you so much for joining us today on ET Now. When it comes to large cap investing, a lot of investors still have that doubt that in large cap funds, is that the case that all the money is being invested in the large cap companies, and what exactly is the categorization of these large cap companies? If you can just help us viewers understand this.
Good evening and thank you very much for having me on the show. See, large cap mutual funds, basically as per SEBI's guideline, will invest minimum 80% of its total asset under management in large cap companies. So definitely the major allocation is in large cap, and rest 20% can be as per choice of the fund manager, maybe in large cap, mid cap, small cap, but major allocation in large cap only. And as per industry practice, large cap means top 100 companies by their market capitalization. So it means when you invest in large cap funds, your major investment goes in large cap companies. So you can understand when we are talking about the top 100 companies out of around 6,000 companies listed in exchange. These are stable. They have very good research. So such companies. So investors, when they invest in large cap, they can see the portfolios are more stable. Now, most of the time, there's I'll say myth, or people think like large cap cannot perform as the mid cap or small cap companies. But if you see, it's a selection of stock, not the market cap. We have seen many times that large caps have outperformed mid cap as well as small caps. So investors, when they're planning their investment for, say, not very long term, say 4, 5 years, 6 years, something like this. So they should have major allocation large cap only, because small caps, mid caps are more volatile compared to large cap companies or large cap funds.
Understood. So the top 100 companies do qualify for the large cap category, and in that, when it comes to mutual fund investing, so the 80% of the money is invested in all the top 100 companies is something that you should know about. But Pankaj, just wanted to touch upon the fact that how to go about investing in large cap funds, because for an average retail investor, what we have seen in the past is that they do see the last couple of years return, or rather the return that the fund has given since inception, or they define a time period and then they decide that whether or not the performance is encouraging enough to make them get into this particular fund. Is that the right strategy to work with?
Srishti, I agree with you that investors mostly see the past performance. See, past performance gives you an idea about the fund and how it has done during a period of time. But you have to see the current portfolio, because what is more important that how the fund is going to perform in future. So when you invest, it's not only the past performance, but also the current portfolio. And second thing, see, within these companies also, if you talk about a large cap, that how much risk has been taken. You have seen many times that many actively managed funds are unable to beat the performance of index funds. See, in large cap, if you talk about the Nifty 50 or Nifty 100 funds or Sensex funds, which are like index funds, so those funds are also large cap funds because they are investing in top 100 companies, top 50 companies. And otherwise, you invest in actively managed funds where the stocks are selected out of those 100 companies or out of those 50 Nifty 50 companies. So in your portfolio, there will not be 100 companies, there will be lesser than this, but then depends the selection of those stocks by the fund manager and their weightage in the portfolio. So that is important. When you see the past performance, that can give you some idea, but always the moment you invest, that time you should see that how your scheme will perform in future. So there are many things to see that how much risk has been taken that can be defined by the beta or alpha or standard deviation, etc. But for the common man, it may not be very easy to understand those parameters. For the common man, what they should do, first thing, that definitely the past performance and not only the since inception, but yes, how the scheme has done in last 1 year, 2 years, because that also gives you some idea. Second thing, if the scheme has performed well in last few years, then you have to see whether the fund manager is same or fund manager has changed, because the performance came because of the expertise of the fund manager. So many times we see that the fund manager has changed now in the scheme. So then you have to see that whether the scheme will be able to perform at the same in the same manner or not. Then other thing is that when you invest in a mutual fund, you should see the fund house performance, not only the scheme, but overall, what is the philosophy of the fund house, what is their strategies, which are working for other schemes. So that will give you some other ideas. So there are more than 100 schemes in this category. And to select it, see the AMC's performance overall, and also check the performance of the fund manager. That is more important.
Well, absolutely. So those are the checkpoints that you should be looking out for. But my last question is that, Pankaj, you have been tracking this mutual fund industry for long, and especially like we are discussing about those large cap funds. As per you, which are the better bets to go for, or rather, on the other hand, which are some of the counters that you don't like, and what are the reasons behind that? If you can just help us, viewer, with some names out there.
Yeah. Srishti, first I'll tell you reason why I don't like and why I like. Liking is only on the basis of performance and on the basis of selection of stocks. Is sometime for a short period of time, performance may come because of higher risk as well. But that will not be able to sustain in long term. So that is why when I select any fund, I see that what the criteria has been selected by the fund manager for choosing those stocks. So based on the performance long term as well as the current portfolio, see like ICICI Prudential Blue Chip Fund is a very old fund in this category and has been a consistent performer, and it has a very good portfolio. So this is one fund. Canara Robeco Blue Chip Equity Fund and Kotak Blue Chip Fund. So these three funds I will recommend in this category, and the funds which can be avoided, like Franklin India Blue Chip Fund, though this is also very old fund, one of the oldest fund I'll say in this category. But for last couple of years, we have seen that scheme has been unable to perform well, even unable to beat its benchmark. So this is one scheme I'll suggest that one can skip. Union Large Cap Fund, another fund, and then PGM India Large Cap Fund. So these schemes can be avoided, and the best three I have told. Though there are more than 100 schemes, so it is very difficult to tell that which 50 schemes are good, which 50 are not good. But then the three scheme in the scheme of my choices, and three schemes I have told that which I do not like.
Well, yes, absolutely. And the reasons are also being given by Pankaj. These are not the recommendations of the channel, but if you want to go and take the advice of Pankaj, so these are some funds that you can be looking at. But apart from that, you need to do your own due diligence, and we try to help you understand what are the factors that you should be looking out for. But let's move on to our queries segment. And Pankaj, a lot many queries lined up. Firstly, let's take the question from Samantha. She says that she wants to invest 10,000 rupees a month in mutual funds and have a medium risk appetite, and her time horizon is 15 years. Talking of goal, she has a goal to have a corpus of 1 crore rupees. She wants some suggestions on which funds to go with and which funds to exactly invest into.
Anta, if you are listening to me, see, mutual fund do not offer you guaranteed returns. So assuming in long term, you expect a CAGR of 12%, 10,000 rupees per month in 15 years, you can expect something like 48 lakhs. And because your goal is 1 crore rupees, so what I'll suggest you, you should invest 12,000 rupees now instead of 10,000. And then you should keep increasing your investment by 10% every year. And in mutual fund, you have a choice of step up SIP, where automatically, if you decide in the beginning itself that every year your investment will be increased by 10%. So this year, suppose you invest 10,000 rupees, next year it will be 11,000 rupees. So like this. So, but you start with 12,000 this year and keep increasing by 10% every year so that you can expect 1 crore rupees in 15 years. And as far as schemes are concerned, I'll suggest you ICICI Prudential Value Discovery Fund, Paramedic Flexi Cap Fund, and also you can have Quant Active Fund. So these three schemes you can have in your portfolio.
Moving on to the next query, Prasanna has sent his portfolio to us and he says that he has been investing in mutual funds for the last 5 years and so far managed to have a corpus of rupees 6 lakhs. He's currently holding 3 mutual funds and the names are, firstly is Nippon India Small Cap Fund, the other one is PGIM Mid Cap Opportunities Fund and the third one is Parag Parekh Flexi Cap Fund. He wants to know from you, Pankaj, whether or not he should stick to these funds as he is looking to get at least 15% returns from these funds. So what is your suggestion and advice coming in on this? Are these funds worthy enough to give a 15% return on an annual basis? And what will be the time horizon looking like?
Yeah. See, first thing, as I said earlier as well, that mutual funds do not offer the guaranteed returns.
Absolutely.
So in long term, you can expect 12 to 15% CAGR, but there's no guarantee. Second thing, for last 5 years, you have been investing and these schemes are good. But now you have to see how long you want to stay invested. If again, you want to stay invested and want to continue SIP for next 10, 15 years, three schemes are good choice. You can continue with them. But if you have a shorter investment horizon, then I'll suggest that you should exit from small cap fund because small cap fund should be considered only for long term. So if you have, say, investment horizon of next 3-4 years or less than 5 years, so then you can consider exiting from the small cap fund. Rest two schemes are good, and then in you can replace that small cap with like ICICI Prudential Asset Allocation Fund or ICICI Prudential multi-asset fund or quant multi-asset fund. But again, I'm saying if your investment horizon is longer, you can stay invested with these all three schemes.
Pankaj, we are running out of time, but before we wrap up, let me quickly take the query of Kiran. He says that he is working professional and want to save rupees 50 lakh over the next 15 years. Please suggest a mix of equity and debt funds. He has a low risk appetite. What will be your suggestion to him?
Okay, because the investment horizon is very long, 15 years, I'll suggest that you should invest more in equity funds only to create wealth and to beat inflation. And schemes are like IPO Sun Life Balance Advantage Fund, which is a hybrid fund investing in equity and debt both. And ICICI Prudential Blue Chip Fund, that is a large cap fund. And last scheme is Canara Rubico Flexi Cap Fund. So these three schemes are my suggestions.